Hi, everyone. As we know, this week's FOMC meeting brought some very important developments. The central bank made headlines by cutting the Fed funds rate by 50 basis points, lowering it to a target range of 4.75% to 5%, signaling a very significant shift in monetary policy. The decision to implement a larger-than-expected rate cut reflects the committee's increased confidence that inflation, now at 2.2%, is under control and will continue to ease. However, concerns about the weakening labor market, with unemployment now at 4.2%, also factored into their decision. This evolving economic situation demands close attention, and the rate cut serves as an important step in managing both inflation and the labor market. Now, the Fed's summary of economic projections released during the meeting forecast a steady GDP growth at 2% through 2026, alongside a very gradual decrease in inflation to the Fed's 2% target, while unemployment is expected to rise to 4.4% this year and remain there at that level through 2026, reflecting the Fed's growing focus on labor market challenges. Now, regarding the dot plots, most Fed officials expect the median Fed funds rate to decline to about 4.375% by year-end, signaling additional rate cuts and a growing consensus for more aggressive action in response to changing economic conditions. At the press conference, the theme of change remained central. Powell emphasized the recent rate cut is part of a broader shift in monetary policy aimed at supporting a slowing economy, but also cautioned that this should not be viewed as the new norm. He did reiterate that the committee's commitment to flexibility with future adjustments, underscoring that all decisions will remain data-driven. So looking ahead, the Fed is anticipated to implement further rate cuts in the final two meetings of this year, potentially lowering the Fed funds rate by another 50 basis points. Now, this decision reflects a growing consensus among the officials that more decisive action is needed to counter slowing growth. Additionally, the Fed may continue to ease rates in 2025 if necessary, aiming to balance inflation control with economic growth while addressing concerns about a weakening labor market. Thank you.
Judy Raneri is Senior Portfolio Manager of the Gabelli U.S. Treasury Money Market Fund. This podcast is an excerpt from Gabelli TV that appeared on September 23, 2024. The portfolio manager's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the individual portfolio manager and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the portfolio managers and may differ from those of other GAMCO officers, portfolio managers, other employees, or the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting.